Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a company that's not just writing, but actively building the explosive wave of AI infrastructure. They're posting incredible revenue growth quarter after quarter, yet for a while they were still pouring money back into scaling their operations at breakneck speed. Now, what if that growth starts to slow, or even better, what if profitability arrives precisely when the market needs it most, ready to supercharge their stock? Today, we're asking a pivotal question about Astera Labs. Is its recent eye-popping growth truly sustainable? When exactly will it become profitable, and what will that mean for its long-term stock prospects? The answers to these questions are key to understanding whether this semiconductor innovator becomes a significant success for patient individual investors, or perhaps a cautionary tale from the frantic AI gold rush. You want to be informed without feeling swamped by information, and we're here to give you that clear, direct insight. We're going to pull back every layer of Astera Labs, from the vision of its leaders to its powerful market advantages, building towards a perspective that could truly shape your investment decisions. To give you the clearest picture, we'll start by understanding the minds behind this operation. Then we'll dive into its unique business, explore its formidable advantages, and see what the latest financial reports tell us. Finally, we'll weigh all the arguments for and against its future. Every truly transformative company has a core team steering the ship, guiding it through complex waters. So, to kick us off, tell us about the brilliant individuals behind Astera Labs' remarkable growth. Who are they, and what makes them uniquely suited to navigate the demanding world of AI infrastructure?
Right. Well, the crucial insight for you as an investor here is that Astera Labs isn't just a company riding the AI wave. It's being steered by a synergistic blend of deep technical vision and operational precision. And this has enabled rapid market capture and set a clear course towards profitability. At the very top, we have Jitendra Mohan, the CEO and co-founder. He's been at the helm since the company's inception back in 2017, bringing with him a wealth of experience from industry giants like Broadcom and Texas Instruments.
Big names.
Exactly. His expertise is specifically in high-speed connectivity, which is absolutely vital for the demands of modern data centers. A pivotal achievement under his leadership was the rapid development of their Aries PCIe retimers. These devices were instrumental in securing early market share within the AI data center space, directly fueling that impressive 144% year-over-year revenue surge we saw in Q1 2025.
That number really jumps out.
It does. And that surge is a strong indicator of Astera Labs' sustained growth, especially given the escalating demands of AI. Mohan's strategic vision centers on championing open standards like PCIe and CXL. This approach has opened the door to critical partnerships with major hyperscalers. These are the massive cloud service providers like AWS, Google, and Microsoft, and could significantly accelerate profitability by diversifying the company's revenue beyond the often volatile cycles of GPU sales.
So diversifying away from just riding the GPU wave makes sense.
Precisely. Complementing Mohan is Sanjay Gajendra, who serves as president, COO, and also a co-founder. His background at companies like Rambus and Broadcom equipped him with extensive expertise in operations and product strategy. Gajendra has been absolutely key in driving operational efficiencies across the company. For example, he optimized supply chain partnerships with leading foundries, like TSMC, which proved vital in maintaining gross margins above 70%, even amidst challenging inflation.
70% margins despite inflation. That's impressive.
It really is. And this operational prowess is a major factor in the company's projected path to achieving GAAP profitability. That's generally accepted. Accounting principles profitability, the full measure of a company's financial health by late 2025 or early 2026. Furthermore, his strategic initiatives, such as expanding the Scorpio fabric switches designed for AI clusters, strategically position Astera Labs to capture a larger portion of the substantial $27 billion total addressable market by 2027.
$27 billion, that's a huge market they're aiming for.
A very large market. And this expansion is poised to boost the company's stock prospects through recurring high-margin sales. Rounding out this core leadership team is Casey Morrison, the Chief Product Officer. His experience from Micron and Intel gives him specialized insight into memory connectivity. Morrison's leadership in launching the Leo CXL controllers directly addresses one of the most significant challenges in modern AI systems, what's often called the memory wall.
The memory wall, right, where GPUs get ahead of the memory.
Exactly. This is where powerful GPUs often outpace traditional memory access speeds, creating a bottleneck.
Yeah.
By providing solutions for memory expansion, his work directly supports the sustainability of Astera Labs' growth. enabling more scalable and efficient AI deployments. It's worth noting that the decisions made by these leaders, particularly their prioritization of research and development spending at 30–40% of revenue, have undoubtedly fueled a relentless pace of innovation.
That's a big chunk going to R&D.
It is. And while this high investment initially delayed profitability, the long-term view suggests that as products mature and market adoption deepens, this investment is designed to transition into significant margin expansion, thereby enhancing the long-term value of the stock.
It's fascinating how a company's entire trajectory can be so heavily influenced by its founders. How involved are Mohan and Gajendra in the day-to-day operations, and perhaps most importantly for our listeners, how do their incentives truly align with your goals as an individual investor?
Well, this is truly a company built from the ground up by its founders. Jitendra Mohan and Sanjay Gajendra are deeply involved in daily decision-making, from meticulously crafting product roadmaps to forging critical strategic partnerships. This isn't merely a figurehead role. Their hands-on approach reflects the outperformance often seen in founder-driven companies.
So they're really in the trenches.
Absolutely. You can see their direct involvement in securing crucial integrations with NVIDIA's cutting-edge GB200 and Blackwell platforms, direct moves that continue to sustain Astera Labs' growth within the current AI boom. It's important to understand that this isn't a situation where a single business genius dominates. Instead, it's the complementary expertise of this duo, Mohan's engineering vision and Gajendra's operational precision, that has been exceptional, guiding the firm from its startup origins to achieving $490 million in trailing 12-month TTM revenue.
Almost $500 million in TTM revenue. Quite a journey.
Indeed. And crucially, their incentives are remarkably well aligned with individual investors like you. Both Mohan and Gajendra hold significant equity stakes in the company, collectively owning around 10–15% post-IPO. This direct financial tie-in means their personal wealth is directly connected to the company's stock performance.
Skin in the game, as they say.
Exactly. Additionally, a substantial portion of their compensation is linked to performance-based stock units that vest upon reaching specific revenue and profitability milestones. This structure vigorously incentivizes them to drive the company towards sustainable growth and positive earnings, which in turn is designed to unlock higher valuations for all shareholders.
So beyond the impressive resumes and hands-on involvement, what's the core mission and culture that truly defines Astera Labs, and how does that internal ethos drive their success?
Astera Labs has a remarkably clear mission: to deliver purpose-built connectivity solutions designed to unlock the full potential of AI and cloud infrastructure through a steadfast commitment to open industry standards like PCIe, CXL, and Ethernet. This mission fuels an ambitious vision articulated by Mohan himself as revolutionizing data center architecture for the AI era.
Revolutionizing data centers. That's a bold vision.
It is. Their goal is to bridge critical connectivity gaps in rack-scale AI deployments. Think of these as massive interconnected systems of servers and GPUs enabling hyperscalers to deploy vast, trillion-parameter AI models without encountering crippling bottlenecks. Looking ahead, the leadership has outlined a future where products like their Scorpio switches are projected to dominate the AI fabric market, forecasting an impressive 45% compound annual growth rate, CAGR, through 2028 for these specific products.
A 45% CAGR projection is very strong.
Very strong. The company's culture is deeply rooted in innovation and collaboration. Core values such as teamwork and customer obsession aren't just corporate slogans. They actively shape daily behaviors, fostering an environment of rapid iteration. A prime example of this agile culture is the remarkably quick adoption and ramp-up of their Aries retimers into widespread use.
So the culture actually translates into speed.
Yes, it does. This culture is a foundational pillar for sustained growth. It helps them attract and retain top talent. The company had 440 employees as of Q1 2025 and ensures that all teams are aligned on profitability goals. This alignment is evident in their successful cost controls, which significantly improved non-GAAP operating margins to 20% in Q1 2025. It's a culture that cultivates both cutting-edge development and, importantly, financial discipline.
Understanding what a company actually does can sometimes feel like trying to decipher a secret code, especially in the semiconductor world. So for our individual investors, let's make it crystal clear. How can we truly grasp Astera Labs' business model?
Okay, let's simplify it. The core takeaway for investors here is that Astera Labs isn't just selling chips. They're providing indispensable plumbing that prevents crippling bottlenecks in the most advanced AI data centers, securing their vital role in the AI revolution.
Plumbing for AI. I like that analogy.
It helps, right? Think of it this way. Their entire purpose is ensuring data flows seamlessly between chips, preventing any slowdowns or bottlenecks. To give you an even clearer picture, imagine a superhighway where AI cars, your powerful GPUs and CPUs, are zooming along at top speed. Astera Labs semiconductors are the engineers that fix any traffic jams caused by distance or interference along that superhighway.
Okay, keeping the traffic moving smoothly.
Yes, exactly. Technically, this involves ensuring high-speed signal integrity through products like their Aries retimers for PCIe connections, enabling memory expansion with their Leo controllers for CXL, and providing ultra-fast Ethernet connectivity via their Taurus cables. They also develop fabric switches, specifically the Scorpio line, which are essential for building high-performance AI clusters. While they constantly adapt to evolving industry standards like PCIe 6.0, which adds complexity.
Which must be a constant challenge.
It is, but the core concept remains simple. They are upgrading the internal data internet of AI systems from a slow connection to the fastest fiber optics available. This fundamental model is designed to support sustainable growth as AI datasets continue to explode in size and complexity. However, it's crucial for you to understand that their path to profitability hinges directly on their ability to scale production efficiently to offset their significant ongoing research and development costs.
Right, scaling efficiently is the key to making the model profitable. Now that we have that clear big picture, let's zoom in a bit more. What are the specific tools and products Astera Labs provides, and why are they so crucial for the AI revolution?
Okay, let's get into the specifics. Astera Labs specializes in semiconductor-based connectivity solutions precisely tailored for AI and cloud infrastructure. They deliver both hardware and software designed to tackle critical bottlenecks in today's data centers. From maintaining signal integrity over long distances to expanding memory capacity and enabling high-speed networking. Their entire product portfolio is engineered to enable rack-scale AI deployments, where massive GPU clusters demand seamless, high-bandwidth connections to manage trillion-parameter models and ever-exploding data volumes.
So they're solving the big connection problems for the biggest AI systems.
That's a good way to put it. This focused approach has resulted in a very strong product-market fit, evidenced by widespread adoption among hyperscalers. For instance, their solutions are integrated into over 90% of major AI platforms from giants like AWS, Google, and Microsoft.
Over 90% integration is huge validation.
It really is. And this translates directly into explosive financial growth. In Q1 2025, revenue hit a record $159.4 million, marking an impressive 144% increase year over year and a 13% sequential jump. This growth was primarily fueled by demand for their PCIe scale-up and Ethernet scale-out solutions, especially within custom ASIC platforms, that's application-specific integrated circuits, custom chips built for a particular use.
So they work closely with those custom chip designs too.
Yes, that's a key part of their strategy. Further validation comes from their design wins with leading GPU providers, notably NVIDIA, where Astera Labs products are deeply embedded in platforms like Blackwell and GB200. This secures sustained market share in high-speed connectivity and positions the company for recurring revenue as AI infrastructure continues to scale. Let's delve deeper into their core product families. First, their Aries PCIe retimers and gearboxes. These are like signal boosters for high-speed data. They enhance data transmission over PCIe interfaces by restoring signal quality over longer distances or in noisy environments.
Which must be common in big data centers.
Very common and absolutely essential for maintaining data integrity. They support the latest PCIe standards and offer incredibly low latency and high power efficiency, both vital for the immense demands of AI systems. The Aries 6 Smart Gearbox, launched in May 2025, specifically helps bridge newer and older PCIe ecosystems, allowing for seamless upgrades.
So making transitions easier for customers.
Exactly. In the context of AI, Aries is vital for enabling high-speed connections between GPUs and CPUs in dense clusters, actively preventing data bottlenecks that could significantly slow down AI training speeds. This product's market fit is incredibly robust. Aries drove the majority of Astera Labs' 2024 revenue growth, surging 242% year over year to $396.3 million, with its widespread adoption across diffuse hyperscaler platforms underscoring its indispensable role.
A 242% surge, clearly a cornerstone product.
Absolutely. Next are the Leo CXL Smart Memory Controllers. These controllers leverage Compute Express Link (CXL) technology to expand memory capacity and bandwidth for intensive AI workloads. They facilitate pooled memory resources across servers, which drastically reduces costs and improves overall efficiency. This product directly addresses what's known as the memory wall in AI, a significant challenge we mentioned earlier where powerful GPUs often outpace traditional memory access speeds. Leo enables up to 2 times more effective memory utilization in large AI models. Doubling memory effectiveness sounds like a game changer for large models. It can be. Adoption indicators suggest a strong future for Leo, with contributions expected to grow significantly in 2025 as the broader CXL ecosystem matures, aligning perfectly with hyperscalers' strategic shift toward disaggregated architectures, meaning separating components for more flexible use. Third, we have Taurus Ethernet Smart Cable Modules. These are high-speed optical and copper cables that provide incredibly fast Ethernet connectivity for scale-out networks, supporting speeds like 400 gigabit and 800 gigabit. Blazing fast speeds. They come with embedded signal integrity features that allow for extended reach without any data degradation. They offer low power consumption and are designed for plug-and-play interoperability. In AI setups, Taurus modules are crucial for facilitating east-west traffic within data centers. This is data moving between servers within the same data center, which is absolutely essential for distributed training across thousands of GPUs.
Okay, so connecting all those GPUs together efficiently.
Precisely. Its market fit is clear from its strong ramp in Q4 2024, significantly contributing to sequential growth, and its pivotal role in Ethernet solutions for custom ASICs. Taurus is projected to account for 20–30% of Astera Labs' 2025 revenue, as AI networks continue their rapid expansion. Finally, the Scorpio Smart Fabric switches represent a flagship offering for AI Fabric, the network infrastructure that connects AI accelerators.
The fabric connecting everything.
Yes. The Scorpio family includes solutions designed for GPU to CPU and SSD connectivity, and for back-end AI accelerator clustering. These switches boast impressive features like readiness for the next generation of PCIe, incredibly low latency switching, and the scalability required for clusters of thousands of GPUs. Scorpio is integrated with NVIDIA's MGX platform for modular AI designs, a collaboration that maximizes GPU utilization by an estimated 20–30% through highly efficient fabric management.
A 20–30% utilization boost is huge.
It's significant. This product is currently in pre-production, having begun shipping in Q2 2025, and has been rigorously tested in Astera Labs' own cloud-scale interop lab, with leading vendors like Micron, demonstrating impressive performance, signaling its readiness for mass adoption. Complementing all this hardware is the Cosmos software suite, which provides comprehensive system management, diagnostics, and optimization tools for fleet-scale deployments. This software enables real-time monitoring and crucial firmware updates, all designed to minimize downtime in critical AI operations.
So hardware and software working together.
Yes, it's an integrated solution. Across this diverse portfolio, Astera Labs has achieved clear product-market fit. Their 2024-2025 revenue trajectories clearly show diversification. While Aries and Taurus drove early growth, Leo and Scorpio are poised to contribute a substantial 20–40% of revenue by year-end 2025.
That diversification is key for stability, right?
Absolutely. It significantly reduces reliance on single product lines, enhancing the company's sustainability amidst the cyclical nature of AI capital expenditures. Furthermore, customer diversity with NVIDIA accounting for approximately 40% of revenue, balanced by other hyperscalers and long-term design wins, often spanning 3 to 5 years, further solidify this market fit. The product roadmap is aggressively focused on integrating next-generation standards to future-proof AI infrastructure. This includes preparing for PCIe 7.0 by 2027, targeting significantly faster speeds, CXL 3.0 enhancements for memory pooling and exascale systems, and multi-generational Scorpio expansions, such as UA link support for even faster accelerator links, which was announced in May 2025 as part of a consortium with over 100 members.
Always looking ahead to the next standard.
They have to. This roadmap is meticulously aligned with the projected 45% CAGR growth of the AI total addressable market to $27 billion by 2027, emphasizing backward compatibility and strategic ecosystem partnerships to accelerate time to market. Recent product launches have been truly pivotal for the company's trajectory. The Aries 6 Smart Gearbox, launched in May 2025, is now ramping production for PCIe 6.0, directly supercharging AI deployments with hyperscalers and contributing significantly to Q2 2025 revenue. Scorpio's pre-production launch in Q2 2025, with its integration into NVIDIA MGX for PCIe 6.0 modular designs, is impacting growth by enabling rapid AI server deployments and boosting GPU efficiency, expected to add 10–15% to 2025 revenue.
So Scorpio is already starting to contribute meaningfully.
It is. And the partnership with Alchip, announced in June 2025, is advancing silicon for rack-scale AI, further enhancing Astera Labs' ecosystem integration and market position. These developments have profoundly influenced stock prospects, with analysts highlighting significant breakout potential as these initiatives diversify revenue streams, and edge the company closer to profitability through high-margin sales, typically above 75%.
In a crowded, intensely competitive tech landscape, what makes Astera Labs truly stand out? What's its unique advantage, its secret sauce that competitors can't easily replicate?
Okay, the secret sauce. The central insight here for you as an investor is that Astera Labs isn't just selling components. They possess a unique blend of specialized expertise, strong financial discipline, and an unwavering focus on AI's most critical plumbing. This creates defensible advantages that are hard for rivals to match. Astera Labs' model truly shines at the unique intersection of specialized expertise in mixed-signal semiconductors, chips that handle both analog and digital signal, strong economic drivers like their consistently high gross margins, which regularly exceed 75%.
Those margins again.
Yes, they're a constant theme. And a clear passion for enabling AI. Their distinct approach involves designing fabless chips, meaning they design the chips but outsource the actual manufacturing, specifically tailored for hyperscalers' custom ASICs. This is a nuanced strategy that sets them apart from more generalized competitors. Consider a crucial example, their integration with NVIDIA's powerful Blackwell GPUs. This partnership specifically addresses the complex retiming needs for incredibly fast Ethernet, which is fundamental to building efficient, large-scale AI clusters.
Something others struggle with.
Something rivals simply struggle to replicate at the required scale. This core uniqueness is a powerful engine for sustained growth, as it helps lock in multi-year design wins, often lasting 3 to 5 years. As these recurring sales begin to compound, this uniqueness directly accelerates their path to profitability. Beyond that, they possess a series of interconnected advantages, or moats, as you might call them.
Let's hear about these moats.
First, they exhibit what we can call monopolistic traits. The company holds a significant market share, over 50%, in PCIe 6.0 retimers for AI, particularly in high-speed connectivity. This position is fiercely protected by an extensive IP portfolio intellectual property, meaning patents and designs of over 100 patents, and their leadership in establishing industry standards.
So high barriers to entry.
Very high. This helps safeguard profitability as the AI total addressable market is projected to grow to that staggering $27 billion by 2027. Second, economies of scale are a significant advantage. As production ramps up, for example, Aries volumes increase by 200% year over year. Their cost per unit drops by a notable 15–20%. This efficiency allows them to achieve those impressive 75% gross margins, significantly outpacing smaller peers.
Scale drives down costs, boosting margins.
Precisely. This scale not only sustains growth by funding further R&D, but also accelerates their path to profitability. Third, network effects are at play, particularly with products like their Scorpio switches. The more AI clusters that integrate Astera Labs solutions, the greater the value of the overall ecosystem through enhanced interoperability. Their partnerships with industry leaders like NVIDIA amplify this effect, locking in revenue.
The more people use it, the better it gets for everyone.
Kind of, yes. Fourth, their counter-positioning strategy is distinct. Unlike some competitors, such as Broadcom, who often push proprietary solutions, Astera Labs focuses on open standards. This flexibility is highly coveted by hyperscalers, as evidenced by their extensive integrations with AWS. This differentiation is key for sustaining market share. Fifth, switching costs for customers are remarkably high. Redesigning complex AI systems to accommodate different connectivity chips would cost millions in engineering expenses, plus significant risks of downtime.
So once you're in, it's hard to switch out.
Very hard. This effectively locks in their customers, directly supporting profitability through sticky recurring revenue. Sixth, their branding as an AI connectivity leader fosters strong customer loyalty, which in turn allows for premium pricing, giving them margins that are maybe 20% higher than some peers. Consistent quality builds trust. Seventh, they have cornered resources. This includes patents on critical CXL technology and a pool of highly skilled talent, many from companies like Intel. Strategic partnerships, like the one with Alchip, provide exclusive access. Their ability to attract top talent with 440 employees focused on AI is a real advantage.
Talent and IP are hard to replicate.
Very hard. Eighth, their process power is unique. They utilize proprietary fabless processes, refined for signal integrity, yielding maybe a 10-fold improvement in efficiency for their retimers. This is incredibly difficult to replicate. Ninth, their proprietary technology is, frankly, superior in many ways. Their solutions are significantly better in bandwidth and efficiency, vital given AI's energy demands. 10th, their timing in the market has been impeccable, hitting the AI boom perfectly. And finally, their speed of execution is a significant edge. Rapid launches like Scorpio in just 18 months outpace rivals and discourage competition.
So a whole collection of advantages working together.
Exactly. These advantages seem highly sustainable, likely for 5 to 10 years, thanks to their IP and partnerships. However, we should acknowledge potential erosion risks. New entrants, maybe from China amid trade wars or major tech shifts, like to optical connectivity, if AI demand were to cool significantly.
A strong past often hints at a promising future. What's Astera Labs' track record, and how adept has it been at adapting to the rapid, often dizzying shifts in the AI world?
Well, Astera Labs, founded in 2017, has achieved significant milestones quickly. A key moment was the launch of their Aries product line in 2020, which successfully captured early market share in the burgeoning AI sector. Their IPO in 2024 further cemented their position, raising a substantial $713 million.
Successful IPO.
Yes. Pivotal moments include their involvement in the CXL consortium in 2023, showing adaptability to memory demands post-ChatGPT boom, and the 2025 debut of Scorpio, timed perfectly for AI fabric needs. Their growth metrics are, as we've discussed, impressive. Revenue surged from $115 million in 2023 to $490 million trailing 12-month TTM by Q1 2025, a TGR over 300%. Plus, they hold dominant market share over 50% in PCIe retimers.
That dominance is key.
It is. The company has also shown remarkable resilience, for example, strategically shifting towards Ethernet solutions amidst trade tensions in 2023. These adaptations position them well for sustainable growth and profitability, even as AI trends rapidly evolve.
And how does this company actually operate on a day-to-day basis? From headquarters to manufacturing, what are the nuts and bolts that keep the business humming?
Okay, the nuts and bolts. Astera Labs is headquartered in Santa Clara, California, and they're expanding to a new global HQ in San Jose, planned for July 2025. This new facility will house R&D and accommodate up to 900 employees, showing commitment to growth.
Doubling down on R&D space.
They are. They also operate specialized design centers, one in Vancouver, Canada, for signal integrity, and another in Taipei, Taiwan, for ASIC development, leveraging that L-chip partnership. Operationally, they use a fabless model. They lease facilities and strategically outsource all manufacturing. TSMC in Taiwan handles chip fabrication, while assembly happens in Southeast Asia.
The classic fabulous semiconductor model.
Exactly. And it's critical because it keeps their capital expenditure money spent on physical assets remarkably low, under 5% of revenue. This lean structure aids their path to profitability. Of course, it also exposes them to geopolitical risks, especially with supply chains in Taiwan and Southeast Asia. But despite these risks, the model enables agile scaling, crucial for sustaining growth.
How much control does Astera Labs have over its entire production process? Do they build everything themselves, or do they strategically partner out? And what are the advantages of that approach?
They show minimal vertical integration. Their core focus is design, fabrication, testing that's outsourced to partners like TSMC.
So focus on design, partner for manufacturing.
Right. While this means less direct control over the production line, it brings big advantages in efficiency through specialization. By focusing on designing complex chips, they potentially reduce operational costs by 20–30% compared to more integrated rivals, like Broadcom. Their supply chain strength is also bolstered by multi-sourcing, like using dual foundries, which helps mitigate disruptions. This agility is key for AI growth. Compared to, say, NVIDIA, which is more integrated in design software, Astera Labs' fabless approach allows for a faster time to market. This speed, plus lower fixed costs, could potentially hasten their path to profitability.
Faster to market is a big advantage in AI. Once these specialized chips are ready, how do they actually get into the hands of the tech giants building the future of AI?
Primarily, they use a direct sales model, selling straight to major hyperscalers like AWS and Google. But they also strategically partner with original design manufacturers, or ODMs, like Foxconn, to broaden their reach. It's a blend.
Direct and through partners.
Yes. They also have an innovative element, online developer portals for their software, like the Cosmos suite, and their cloud-scale interop labs for testing boost engagement and ensure smooth integration. This multifaceted strategy supports their impressive scalability, shown by that 144% year-over-year revenue growth. By embedding their solutions into long-term designs, they enhance customer stickiness and ensure sustained growth.
For individual investors, knowing how predictable a company's revenue is can be crucial. How stable are the sales, and how much can we count on them as the company approaches profitability?
Right, predictability is key. While Astera Labs' revenue can show some variability, tied to AI capital expenditure cycles, a significant chunk, maybe 60% to 70%, is recurring.
60 to 70% recurring, that's quite stable.
It is. It comes from multi-year design wins, typically 3 to 5 year contracts with hyperscalers. We saw in Q1 2025 they had solid 13% sequential growth, with projections for annual increases over 50%. This underlying stability is incredibly beneficial for financial planning and helps reduce revenue volatility as they get closer to full profitability. Those long-term contracts, especially NVIDIA integrations, ensure a strong baseline revenue even with fluctuating AI demand. It provides a good foundation.
This is where it gets truly fascinating. In any cutting-edge industry, what truly sets a company apart? What are the fundamental advantages that protect its market position and ensure its long-term success?
Okay, let's talk about those fundamental advantages, or moats. The core insight for you as an investor is that Astera Labs has built a series of interconnected, robust advantages. These aren't easily replicated and are specifically designed to protect its market share and profitability as the AI revolution continues. We touched on some already, but let's list them clearly. First, those monopolistic traits. Near monopoly in PCIe 6.0 retimers for AI, 50% plus market share, protected by 100 plus patents and standards leadership. This protects profitability as the AI TAM grows towards $27 billion.
The patent portfolio is a big one.
Huge. Second, economies of scale. Ramping production drops unit costs 15–20%, yielding those 75% gross margins, outpacing smaller peers. This funds R&D and speeds up profitability. Third, network effects, especially with Scorpio switches. More users increase ecosystem value via interoperability, amplified by NVIDIA partnerships. It locks in revenue. Fourth, counter-positioning, focusing on open standards versus proprietary solutions which hyperscalers prefer. Think AWS integrations. This sustains market share.
Open standards is a key differentiator.
Definitely. Fifth, switching costs. Redesigning AI systems is expensive and risky, locking in customers and supporting profitability through sticky revenue. Sixth, branding. Their AI connectivity leader brand builds loyalty and allows premium pricing, maybe 20% margins over peers. Quality builds trust. Seventh, cornered resources. Patents on CXL tech, top talent from places like Intel, and exclusive partnerships like Alchip for ASICs. Talent attraction is strong with 440 AI-focused employees.
Access to talent and specific tech.
Critical. Eighth, process power. Unique Fables processes yield perhaps 10x better efficiency in retimers, hard to replicate, sustaining cost advantages. Ninth, proprietary technology. Simply put, it's often 10x better in bandwidth and efficiency vital for AI energy needs. 10th, timing. Perfect alignment with the post-2022 AI boom, giving a first-mover edge in CXL. And finally, speed of execution. Rapid launches like Scorpio in 18 months outpace rivals and discourage competition, key for sustaining growth.
That's a comprehensive list of advantages, very strong moat.
It is. And these advantages seem sustainable for 5–10 years via IP and partnerships. But again, risks exist. New entrants, tech shifts to optics, or AI demand cooling could erode them.
Looking ahead, what's Astera Labs' roadmap for continued expansion, and how well-equipped is this company to weather potential storms in the market?
Their growth strategy is clear and multi-pronged. Penetrate existing markets deeper with area stores, develop new geographies like Asia, and innovate products like Scorpio. The main driver is massive AI capital expenditure, over $200 billion annually. Mechanisms like R&D alliances accelerate adoption, sustaining growth as profitability nears.
So riding that huge wave of AI spending.
Exactly. For growth potential, opportunities include new markets like automotive AI, new products like PCIe 7.0 support, and maybe strategic M&A with smaller connectivity firms, though that carries integration risks. The reward. Aiming for that 45% CGR. Past successes like CXL adoption provide a good track record. Their total addressable market, TAM, is huge, growing from $17 billion in 2023 to $27 billion by 2027. They target 10–15% share, mainly via AI segments, helped by NVIDIA ties.
10 to 15% of $27 billion is still a massive number.
A very significant target. Their applications are broad, cloud, and edge AI, but their niche in hyperscalers implies scalable growth and resilience in downturns. Regarding supply chain diversity, they use TSMC Taiwan plus Southeast Asia. It's diversified but still vulnerable to U.S.-China trade issues. Mitigation includes stockpiling.
Trying to build resilience there.
Yes. Customer diversity is also a strength. NVIDIA is about 40%, but the rest is spread across other hyperscalers and geographies, stabilizing revenue. The longevity of their products seems high, maybe an 80% probability they'll be needed long-term, as AI is a secular trend. They seem capable of weathering downturns with over $600 million in cash. Data explosion trends position them well.
So strong underlying trends support them.
Correct. Key growth drivers are AI infrastructure demand, product ramps, partnerships. Main risks are saturation if AI hype fades significantly, and competition from giants like Broadcom.
No company operates in a vacuum. What are the big economic forces at play, and how might they impact Astera Labs' journey to sustain growth and profitability?
Good point. Several macroeconomic forces matter. First, interest rates. Rising rates increase borrowing costs. While Astera Labs has minimal debt, it affects their partners' capital spending, potentially slowing AI investments and delaying Astera Labs' profitability.
So an indirect impact through customers.
Exactly. Next, trade tensions, especially U.S.-China. They could disrupt TSMC supply, diversification helps, but tariffs could still raise costs and impact margins. Inflation is another factor. It can squeeze R&D budgets, about 30% of their costs. High gross margins provide a buffer, but reduced consumer AI demand could indirectly affect investment.
High margins help absorb some inflation shocks.
They do. Finally, company-specific macro impacts. Semiconductor cycles matter. The current AI boom causes chip shortages, which might boost prices for Astera Labs, aiding growth. Also, rising global energy costs favor efficient solutions like theirs, making them more attractive to hyperscalers worried about power consumption.
Interesting how high energy costs could actually be a tailwind for them.
It's a specific angle, yes. Their efficiency becomes a bigger selling point.
Let's talk numbers. What do the latest financial reports tell us about this company's health, its growth trajectory, and its path to profitability?
Okay, the financials. For individual investors, they paint a compelling picture. A growth story right on the cusp of significant profitability. Think of a startup athlete training hard, anticipating a massive payoff. Let's hit the key metrics. Revenue growth. Q1 2025 hit $159.4 million, up 144% year-over-year, 13% quarter-over-quarter, driven by Aries ramps. This signals sustainable AI tailwinds.
That 144% year-over-year is still staggering.
It really is. Now, profit margins. Gross margin is a robust 75%. Non-GAAP operating margin is 20%. While they had a GAAP net loss of $93 million, mostly due to one-off IPO costs, their non-GAAP profit of $31.8 million shows a clear path to full profitability. Their Rule of 40% score is impressive at 164%, 144% growth plus 20% margin. That's very strong for a growth company, indicating great product market fit.
Well above the 40% benchmark.
Way above. Return on invested capital, ROIC, is around 15% and improving, reflecting efficient capital use, especially in R&D. Financially, they're strong. $600 million cash, no debt, current ratio 5x, plenty of runway for growth.
Healthy balance sheet.
Very. Book value growth is up 200% post-IPO from equity infusions. Free cash flow was negative $50 million TTM due to heavy R&D, but it's projected positive by 2026. That inflection is key. Looking at specific metrics, R&D is about 35% of sales, showing innovation focus, over 20 AI design wins. And gross margins beat the semiconductor average of 60%.
Outperforming the industry on margins.
Significantly. Compared to peers, revenue growth crushes Broadcom, around 20%. Margins align with NVIDIA, 75%. ROIC lags mature peers, but that highlights upside potential as profitability hits. The trends are clear. Revenue tripled 2023-2025. Margins expanded 10 points. Free cash flow turning positive implies a stronger future, sustaining growth.
Beyond the raw financials, what's happening right now in Astera Labs world, and what are individual investors buzzing about?
Okay, the current pulse. Recently, they had that strong Q1 2025 earnings beat in May, the Scorpio partnership with Alchip in June, and opened the new San Jose HQ in July. Coming up, Q2 earnings on August 5th. This will be crucial for investors to watch, especially for Scorpio ramp updates, potentially confirming growth sustainability.
So August 5th is a key date to watch.
Definitely. Investors are also eyeing DesignCon 2026 previews for future tech. Externally, potential NVIDIA Blackwell delays could be a pressure point, but Astera Labs' involvement in the UA-Link consortium is a positive counterweight. The current narrative among individual investors, particularly on social platforms, is largely bullish on Astera Labs' AI positioning.
Mostly positive sentiment, then.
Mostly, yes. But the main concerns around valuation and the exact timing of full profitability, especially with market volatility. The dominant narrative is optimistic about sustained growth via NVIDIA ties, referencing the 45% CAGR potential and the $27 billion TAM, emphasizing resilience post-corrections. Sentiment breakdown. Roughly 70% positive, with mentions of stock surges tied to CEO insights. About 20% neutral, focusing on valuation debates, and maybe 10% negative, citing downgrade fears like Northland's $120 target.
A mix, but leaning positive.
Correct. Investor priorities are squarely on the path to GAAP profitability, projected for late 2025. Beat and raise earnings trends fuel the bull case. The focus is on the fundamental AI moat, not just hype.
Now, for the critical question for any individual investor, what is Astera Labs stock currently worth, and does it offer a compelling opportunity?
Right, the bottom line question. The key insight here is that Astera Labs' current valuation reflects a complex balance. Investor excitement for its AI role versus the inherent risks of a high-growth, newly profitable company. Understanding this balance is vital for your investment decision. As of July 28, 2025, the stock is trading around $122.23 per share. That's a big year-to-date gain, about 159% from post-IPO levels, but it is down from its 52-week high, near $147, reflecting some AI sector volatility.
So a big run-up, but also some pullback.
Exactly. This gives it a market capitalization around $20.16 billion. This valuation captures that huge investor enthusiasm for its AI connectivity role, while also pricing in risks related to growth sustainability and the timeline to consistent profitability. Hitting milestones could propel it higher, slowdowns could cause corrections.
For the prudent individual investor, the concept of a margin of safety is paramount. How does this classic investing principle apply here for Astera Labs?
Margin of safety. Crucial concept. The core insight for you is that applying this principle here means carefully considering if the current stock price offers a sufficient protective buffer against potential risks, ensuring you're not overpaying in a volatile sector. Margin of safety, popularized by Benjamin Graham and Warren Buffett, means buying stocks at a significant discount to their estimated intrinsic value. It's a buffer against uncertainty, errors, market downturns.
Protection against being wrong, essentially.
In a way, yes. For Astera Labs, it means asking, does $122 offer enough buffer against risks like delayed AI deployments or tougher competition? If you estimate intrinsic value is, say, $150, $200 based on growth projections, buying at $122 gives you a 20–40% margin that cushions you if growth is slower or profitability takes longer. Without that margin, overpaying could amplify losses, especially in volatile AI. That's why value investors often wait for pullbacks, especially as a company like Astera Labs transitions from high growth losses to profitable scaling. A good margin protects capital while allowing upside.
Why does valuation even matter so much in a fast-moving market like AI? It's not just an academic exercise, is it?
It's definitely not academic. The key insight is that valuation acts as your compass. It prevents you from overpaying for future growth and ensures the price you pay today aligns with the company's sustainable earnings power. This is especially critical in the rapidly evolving AI landscape.
A compass. Good analogy.
Valuation guides whether a company is a bargain or a potential bubble. For individual investors like you, it reveals if the price reflects sustainable growth and coming profitability, helping avoid overpaying during AI euphoria. For managers, it guides capital allocation. For everyone, it gauges financial health. In Astera Labs' case, with huge growth but recent profitability, valuation is critical. Overvaluation could mean a sharp sell-off if growth moderates. Undervaluation offers asymmetric upside as profitability boosts cash flow and stock appeal. It contextualizes metrics like that 70x forward PE. High for semis may be justified if they sustain 45% plus CIGR and capture the AI TAM, or a red flag if profitability delays erode confidence. It's about potential versus price.
Given all these factors, what are the best ways to value a company like Astera Labs? And what do different valuation approaches tell us?
Good question. The key insight is that for a high-growth, AI-focused company like Astera Labs, a blended approach combining intrinsic valuation with relative comparisons provides the most comprehensive picture. The focus shifts from current losses to future profitability potential. You really need a blended approach. Traditional metrics like a trailing PE of 378x are misleading due to early losses in R&D spend. We need forward-looking methods. The discounted cash flow, or DCF model, is ideal for intrinsic value. Project future free cash flows, discount them back. Let's say assume $709 million revenue in 2025, growing 45% CAGR to $1.92 pieces by 2029, margins expanding to 25%.
Plausible assumptions based on their trajectory.
Reasonably so. With a 10–12% discount rate for AI risks, DCF yields an intrinsic value maybe around $150–200 per share. But sensitivity analysis is crucial. Bull case, 50% growth, could be $250 plus. Bear case, 30% growth, maybe $80–100. Then there's relative valuation comparing to peers. Astera Labs' 20x forward sales dwarfs the semi-average, 10x, but aligns with AI plays like NVIDIA, 25x, justified by 144% Q1 growth, but vulnerable if sustainability falters.
So it depends which peers you compare it to.
Exactly. Their enterprise value to sales, EV sales, is around 30x TTM, highlighting perceived scalability. Other methods, sum of parts. Value Aries at $10, Scorpio at $5 perhaps. The PEG ratio is 1.19, suggesting reasonable growth pricing. Conclusion. DCF and relative valuation suit Astera Labs best. Intrinsic valuation is key for long-term prospects, as profitability should unlock lower multiples over time.
Now we get to the heart of the matter. For individual investors, it comes down to two compelling arguments: why you should be excited and why you might want to be cautious. Let's unpack both the bull and bear cases for Astera Labs.
All right, let's steelman both sides. First, the bear thesis. Analysts like Northland, $120 target, and skeptics argue it's overvalued at 70x forward PE and 20x sales, far above semi-peers, recalling AI hype cycles that deflated before, like 2022's 50% sector drops. Core concern. Growth sustainability question. If hyperscaler spending cools post-2025, maybe by 10-20%, it could erode that 45% CAGR projection, as PCIe CXL demand links to volatile GPU ramps.
So dependent on continued massive AI spending.
Heavily. Bears also worry about profitability delays. If Scorpio ramps slower than hoped, only 10% of 2025 revenue, full profitability might slip to 2027. That means continued cash burn, negative $50 TTM SCF, and potential share dilution from equity raises. Competition is another risk. Broadcom's integrated solutions or new Chinese entrants amid trade wars could take 20-30% market share. A negative EV bid flags inefficient capital use.
What about retail sentiment for the bears?
Retail echoes caution. You see comments like stock down 33% YTD on hype fade, wait for $80 entry, or profitability mirage, Q1 EPS, $2.26, but margin squeeze if inflation hits 5%. Bears see 30-50% downside to 60-80 if an AI winter hits, viewing it as a speculative trap. Now, the powerful bull thesis. Institutions like Jefferies, $130 target up from $95, championed as an AI picks and shovels winner.
The essential tools for the gold rush.
Precisely. Bulls highlight proven sustainability, 242% 2024 revenue growth, Q1 2025's 159 uplifts, 144% YoY, driven by NVIDIA integrations and Scorpio ramps. Key point. Earlier profitability. TTM profits 41 members, EPS or $26, GAAP positive projected Q1 2025 earlier than expected. This unlocks positive FCF by 2026 and multiple expansion to 25x sales, driving potentially 100-200% upside. Bulls emphasize the market capture opportunity. 27B TAM by 2027. Astera Labs capturing 10-15% via moats like 100+ patents and UA Link leadership, sustaining 37% plus KG to $1.92 beast by 2029.
They see the moats as strong enough to capture that share.
They do. Risks are seen as mitigated by partnerships, Alchip, Micron, and diversified customers. NVIDIA 40%, rest hyperscalers. Retail sentiment for bulls is buoyant. Scorpio plus PCIe 6 equals 10x better AI efficiency, PT $200 by 2027, or beat and raise Q2 guide seals profitability by dips. Focus is on AI secular trends outweighing macro headwinds. Bulls project may be $325 by 2028, 258% upside, viewing current price as discounted entry.
So two very different outlooks. Which is more probable?
Considering all the evidence, the most probable thesis, in my view, leans towards the bull case, maybe a 60-70% likelihood.
Why the bull case edge?
Primarily due to the enduring AI demand data centers projected at $200 beer angel capex, and Astera Labs' strong Q1 results affirming growth sustainability. Plus, profitability is materializing now, enhancing stock resilience and likely attracting more institutional money. The execution seems to be there.
So, what does this all mean for your portfolio? After dissecting every angle of Astera Labs, let's bring it all together and answer the core questions we set out to explore.
Okay, let's synthesize. On growth sustainability, we see a high probability, 75-85%, that growth continues over the next 3 to 5 years. Core reason. Its pivotal role in AI infrastructure amid exploding data demands. Q1 2025 revenue, $159 or fence, 144% YoY, 13% QoQ, shows this. Driven by Aries Taurus ramps, with Scorpio poised to exceed 10% of 2025 revenue.
Driven by unstoppable AI trends?
Largely, yes. Secular trends like trillion parameter model training require flawless connectivity. Its open standard tech, PCIe 6.x, CXL 3.x, addresses bottlenecks effectively, evidenced by NVIDIA Blackwell integrations in UA Link leadership. Qualifiers: dependency on AI capex, risk of 10-20% slowdown if economy bites, and execution on ramps. Past adaptations are encouraging, but geopolitical risks, TSMC could trim 15-20% growth. Now, the profitability timeline. Astera Labs has turned the corner faster than expected. Non-GAAP profitable Q1 2025, JAP positive projected same quarter, EPS sort of $3 or sort of 4 outlook. TTM per app is already $41.39 on 26, sir.
So profitability is basically here now.
Effectively, yes. Reasons. Gross margins hold at 75% despite R&D of 35% sales. Scale effects kick in, unit cost down 15-20%. Recurring design wins, 60-70% revenue, stabilized cash flows. Projection. By 2026, expect consistent GAAP profitability, margins expanding towards 45%, SCF turning positive from $50 TTM via efficiencies and reduced burn. This profitability inflection profoundly enhances long-term stock prospects. It shifts perception from speculative growth to quality compounder. Potentially re-raise multiples from 70x forward PE towards 50x or lower, maybe like NVIDIA's post-profit surge, stock plus 200% then.
A significant potential re-rating.
Huge. For individual investors, SDF funds R&D without dilution, potential for dividends buybacks later attracts value funds. We project 50-100% stock upside by 2027 if growth holds, turning $122 into $200-300 potentially. It validates leadership bets like Mohin's 2023 CXL pivot. Profitability validates this, insulating against downturns. They weathered 2022 crash with $900 of cash, but monitor Q2 guide, $170, $175 delays could cause stagnation or 20-30% drop. Some final thoughts and maybe some asymmetric information for you. First principles. AI success hinges on efficient data flow. Astera Labs tech enables this, much better than the legacy solutions. Asymmetric info point. Track unreported design wins. You might find hints in partner filings, like Alchips. These can be leading indicators for 2026 revenue, often missed by those focused only on headline AI stocks.
Looking beyond the obvious headlines.
Exactly. Now, a broader thought. Bitcoin. As a pristine reserve asset with a finite supply, unlike fiat, it could potentially serve as a treasury hedge for a company in a volatile sector like semis. Think 5-10% allocation like MicroStrategy could stabilize balance sheets, potentially amplify returns, given Bitcoin's historical cycle performance relative to stocks. It's a strategic thought about diversification and hedging in this space.
An interesting, perhaps unconventional strategic consideration.
It is. Now, known unknowns. Macro slowdowns cutting AI budgets, track hyperscaler reports. Competition eroding moats, monitor Broadcom filings. Unknown unknowns, disruptive tech like quantum interconnects obsoleting PCIe. Unforeseen AI energy regulations, capping deployments. Your edge as an individual investor. Analyze engineer sentiment on social media about integrations. PCIe 6 discussions show adoption speed. Consider the strategic value of things like Bitcoin treasuries. Its potential long-term success offers diversification, maybe turning volatility into advantage if adopted.
What an incredible journey through the intricate world of AI infrastructure and the company powering its growth. We've unpacked the brilliance of its leadership, the ingenuity of its products, the strength of its competitive advantages, and the compelling path to profitability. We've looked at the numbers, weighed the arguments, and given you the tools to see beyond the headlines. Remember, understanding these complex layers is how you gain an edge in a rapidly evolving market. The insights we've shared today, from understanding signal flow in AI data centers to connecting it with macro trends and even the potential of Bitcoin in corporate treasuries, are designed to give you that aha moment and spark further curiosity. Thank you for joining us on this exploration. We hope this knowledge empowers your decisions and enriches your perspective as an individual investor. Until next time, keep learning, keep questioning, and keep exploring the fascinating world around us.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.